aimed at reducing the tax compliance burden. It is based on turnover, total sales or revenue, rather than taxable income profits, meaning that in terms of turnover tax, expenses are irrelevant. You cannot deduct expenditure. It's tax on sales or revenue. Then the question is, who qualifies? If you are a business making a turnover of not more than R1 million, meaning that annual turnover must not exceed R1 million, and only South African residents can apply. And the business must not be a personal service provider like lawyer, accountant, or architect. Engage in certain activities, excluding activities like mining. Not more than 20% of turnover should be from investment income or income from rendering professional services. Investment income, we're looking at interest and dividends, and income from rendering professional services. It must not be more than 20%. So if it is more than, then it means you don't qualify to register this type of tax. And it has its own tax table based on the sales or the revenue. As you will use this table when we do an example. A sole trader with 400,000 turnover. Then because 400, it belongs or is in this category, then it will be 400 minus, it will be equals to 400, 1, 2, 3, minus 335 times 1%, 650. Let's see if that's the case. Yes, it's how to get to the tax using their own tax table. Again, 900,000. And when you look at the table, 900, it falls between 750 to 1 million, meaning that it will be equals to 900, 1, 2, 3, 900,000 minus 750, 1, 2, 3, multiplied by 3%, 4,500. Let's see if nine. All right, let's go to it says plus 6,650. Yes, if it is this, then we need to add 6,650. Yes, is this amount plus 6,650, 11,150. Let's see. Yes, 11,150. That's the tax on 900,000 for turnover tax for micro business. Then the benefits, no VAT, but it's optional. It means you don't have to register as a VAT vendor. But in some cases, yes, SARS can allow you, but no capital gains tax that need to be form part of your calculation. No dividend tax. No need to file full financial statement, meaning you can only file profit and loss statement under the turnover tax. That's the benefits. Then on 1 March 2014, Mohammed Ahmed, who is 25 years of age, started a new business, Candlelight, of producing and selling candles. Candlelight was never obliged to register as a VAT vendor and also did not choose to do so because it qualified as a micro business. The following information is relevant for this company in the 2024 year of assessment. That for debt allowance deducted of 7,500, asset losses in 2024 was 2,345. However, look at this. One of the reasons why some of the company opt to go for turnover tax, it says recoupment assessed losses and previous allowances are not carried into turnover system, meaning that if the company incurs these things, they do not form part of the calculation because it's based on the sales or revenue. No expenditure, no dividends, no capital gains tax. Then this information was given. We're done with this. Okay, yeah. Cash receipt, there's a note for that. It says included in the cash receipt for 2025 is 20,000 receipt from outstanding debtors as of 29 February 2024 and amount refunded from suppliers on damaged goods purchased of 12,000. Then we have outstanding data note 2. It says on the 20th of June, 3,000 of the 395 receipt was also refunded to a customer who bought candles that did not want to light. And note 2 again says party hire still owed candlelight 10,000 for candles delivered on the 20th of February 2025. Let's see note 3. Note 3, it talks about the process with this sale of mixer. It says the candlelight needed a larger mixer to mix the wax for the candles and purchased a new mixer. Candlelight sold the old mixer and received 20,000. The mixer was wholly used for business purposes. Then the question is calculate Candlelight standover tax liability for the 2025 year of assessment. Doubtful debt allowance is nil. Why? Because we are told that when you are registered on this tax type turnover, you are not allowed to claim this particular allowance. No allowance, recoupment expenses. They don't form part of the calculations. Only on the
Hello?
receipt. Yes.
Toi, je t'ai dit, j'étais en bas depuis 18 heures. Tu m'as pas appelé, tu n'as rien dit.
Okay, let's continue. Serge, Serge, can you please mute yourself?
Sorry.
All right, let's continue. Get receipt. Note 2. We have got 395, of which it was given. However, in note 2, they are saying, get receipt, including this amount is 20,000 received from outstanding debtors on 29 February 2024, and amount refunded from the supplier of that is 12,000. And again, there is another transaction that the 3,000 was refunded. Then, because those amounts were, they must not form part of that category, so we need to take them out. Because 20,000 it was for 224, 12,000 it is for refund. Let's just check whether it's received amount refunded. It was refunded. Then it means it must be excluded from 395. And again, 3,000, same thing. Because they're told that 3,000 received was also refunded, meaning that it does not form part of this category. Originally, it was 395,000. However, out of 395, there's certain amount that has been refunded to the customer due to maybe damage or any other factors. That's why we need to take them out so that we can calculate our actual receipts of 360,000. Yes.
I, I just wanted to find out if on this turnover for enterprises, do you also add the credit sales?
We add,
The credit sales.
yes, yes, yes.
Okay, thank you.
If the credit sales was there, then yes. Unless a sale was made, then it must be included. Guys, there's one who's making, I don't know what's happening. I cannot even hear them. I can't
Right
hear
now, can you
that.
mute
Is
them
it a
now?
question?
No, it's not a
Listen them
question.
correctly. I don't know.
Okay.
It's fine now.
Okay. Outstanding data is nil. Why is nil? Because nothing was received. We know that there is outstanding data, but nothing was received. It says the outstanding data does not constitute amount received. Therefore, it's excluded because we are not told that this amount of data was received from a data. It just says outstanding data. Then it doesn't tell us that amount was received. If something was received out of that, then it will then yes be included as an income because it's what turnover tax is based on. Interest received, yes, it is given 25,000. Then dividends, not 5. And when we start this, they say it does not include the investment income. Let me just see, not, it says not 5. It says dividends received also constitute investment income, and investment income other than dividends and foreign dividends is included in the taxable turnover of companies. Therefore, the dividends are not included in the taxable turnover. That's why we say it is nil. Then expenses incurred, we know under this type of tax, you don't take expenses into account. It's only based on sales of revenue. Let's say the proceeds of the mixer, they say 20,000, but look at this, it's 50% of that 20,000. Why? Because when you look and read in your book under the 10 over tax system, the 50% of the proceeds rule applies when a small business disposes of a business asset, meaning that only 50% of the proceeds is included in the taxable turnover. It is stated in the textbook that you have under the turnover, I'm just chapter 10 something. There is a special rule under the turnover system that any proceeds that you made on the disposal of asset, only 50% of that will be included, will be allowed. That's a special rule. Then the turnover, because it's what they said we must do, the tax liability. But first we need to have the taxable turnover of 395,000 years. Then the tax on it, again, is 395. Let's go and look at our tax table. 395 is somewhere here. Yeah, it falls between 335 to 5,000. Then it will be equals to 395, 123, minus 335, 123, multiply by 1%. 600. Let's see if we are getting the same figure. Yes, we are getting the same figure, meaning that our liability is 600 on the taxable turnover of 395,000. Then meaning that this company has to pay 600 to the tax authority. Then purchased by a company of its own shares. Here we are talking about the share buyback. And what are the tax consequences or the implications? It says a share buyback or repurchase is when a company buys its own shares from shareholders. This can reduce the number of shares in circulation, often increasing the value of remaining shares. The legal framework, it means under this Company Act, must be authorized by the board and sometimes shareholders. When you want to purchase, shares from your company, then it makes sense. It must be authorized first before the company can be able to issue that statement that they are selling these shares to its shareholders. Solvent and liquid after the buyback. What does it mean, solvent and liquid? Meaning that following the repurchase of its own shares, a company must still be able to pay its debts and have enough cash or easily accessible assets to meet its short-term obligations. Liquid, not prejudicing creditors or minority shareholders, meaning that ensuring that actions taken, such as asset transfers or restructurings, do not unfairly harm or reduce the ability of creditors to recover debts owed to them. Types of buybacks: voluntary buyback, shareholders sell back willingly; mandatory buyback, triggered by contract or condition; open market repurchase, bought on the stock exchange, of which there's no relationship between shareholders or employees with the company. You buy them like everyone else at arm's length. Arm's length, yes. Purchase by a company of its own shares still continue. Payback from Payment from buyback is usually made from retained earnings or capital. May trigger capital gains tax from the selling shareholder. For the company, because yes, it can trigger that. Because remember, the shareholders, they are not in the business of buying and selling those shares. Those shares that are there for investment purpose. That's why it says it may trigger capital gains tax when they dispose those as shares. For the company, not deductible as an expense. Let's see this example. Company XYZ has 1,000 shares in issue. It buys back 200 shares at 100, meaning that it sold these shares to its shareholders, 1,000. However, along the line, it bought 200 back. Then it's 200 multiplied by 100 rands, because one share cost is, it buys 200 shares at 100 rands. Yes, it means the cost is 100 rands for 200, of which is 20,000. Meaning that now it left with 800 because it's already sold 200. Then earnings per share likely to increase. How? How? Because the company's earnings are now spread over fewer shares, 800 instead of 1,000, after the share buyback. Let's see another example. Shareholder bought 1,000 shares at 50 rands, of which is 5,000. Company buys back 100. It will be 10,000. Capital gain, because they bought 5,000, but they sold 10,000. Therefore, there's a gain of 5,000. In the hands of individuals, meaning that 5,000 is to be taxed at 40%, of which the gain will be 2,000. Why companies do buybacks? That's the question that we need to ask ourselves. Return cash to shareholders, yeah, improve financial ratios, prevent hostile takeovers. Hostile takeovers, maybe people from outside signal undervaluation of shares. Let's see this case study of Sarah's home baking business. Sarah runs a home-based cake business. Her annual turnover is 600,000. Expenses 300. The net profit is 300. And how much does she has to pay? Is 600 turnover minus 500, of which it falls under that category, multiplied by 2% plus 1,650. Let's see if the total is right. Is equals to 600,123 multiplied by 2% plus 1,650. 365. Yes, yes. Then again, on the profit, because there's a profit of 300,000 of which it is given, then 27% of that profit then is 81,000. Then she saved 77,350 because 81,000 minus 3,650, that is the total tax that was already been paid. Then saving 77,350, of which it says is ideal for her to use the turnover tax. Profits chargeable to company tax. Recognize gross income. Gross income, we know by now that includes all income received or accrued to the company in a tax year, excluding capital receipts, of which it includes sales revenue, interest income, rent, royalties, dividends. However, it needs to be exempt, but it must be included in the calculation of gross income and at a later stage be exempted. Let's say an example. The sales 2 million, rent 100,000, interest from savings 20,000, meaning that the gross income is 2 million, of which yes, 2 million plus 100,000 plus 20, 2,120,000. Recognize allowable expenditure. They say allowable deductions. We know that they must be in getting the production of income. Here we are looking at section 11A. Examples of allowable expenditure: salaries and wages, rent, utilities, repairs and maintenance, legal accounting fees, depreciation via capital allowances. Let's see operating expenditure. Yes, 400, 128, of which it comes to 550,000. Let's see. Relief for pre-trade expenditure. We know by now what do we mean by pre-trade expenditure in terms of section 11 cap A. It says those are expenditure which are to be deductible once trading starts. Example is this company again, it incurs 50,000 on market research before starting operations in June. Trade begins in September. It's a yes in terms of section 11A, yes, that amount will be deducted when the company start trading. Research and development tax deduction. When you look at these slides, we have covered the companies. When you look at the textbook that we are using, we have covered each and every component. It says companies engaged in scientific or technological research and development can claim 150% deduction on qualifying research and development expenditure. And for it to be allowed, it must be registered with the Department of Trade and Industry. What are those qualifying research and developments? Is developing new products or processes scientific experimentation. Yes, you know, what the researchers, if there is a company that has been tasked to do a research on behalf of another company, then it will be form part of this. And when it claims, it must claim up to 150% of the amount that has been charged. Let's look at the example. Tax Solution spends 1 million on research and development. And because the company already paid the services of professionals to do research on its behalf, then it cannot claim the full a million rand, but only 150 of that. Then look, it's 150, 1.5 million deduction. Why, guys, is so much? Why? Now you can claim 150. You can put that in the chart. It is there. It's on page. No, I forgot the page. I was looking at the page in your textbook. Because the department, they encourage the research and the technological advancement. So it's a motivator for the company to engage in this kind of development in the research. I can give an example with University of Johannesburg. Most of the universities, when employees produce research, produce papers, produce articles, the Department of Higher Education, they pay UJ for that paper of yours that has been accepted. Then it's the encourage and the motivate for the companies to engage in this kind of things under Section 11 Cap D. Capital allowance, we know under Section 11E, the right of period, manufacturing, and we know non-manufacturing is over 3 periods, 50, 30, 20. But if it's a manufacturing, it's 40, 20, 20 over a period of 4 years. Let's see. PC buys equipment for 300,000, came 120 year one, 40 rule for manufacturing equipment. Let's see. You see what's true? Yes, 40% of 300,000. Interest paid and received. How do we account for this? For tax purposes. We know interest received, it forms part of your gross income. Interest paid, yes, it's deductible. If it is used for trade, ABC receives 15,000 interest on its fixed deposit. It pays 10,000 on a business loan. Then meaning that it will be 15,000 taxable because it's a receipt. It just received it, and the act allows it. Because when we look at section 1 definition of gross income, whatever you received or accrued, it must be included in your gross income, except if it's of a capital in nature. 15,000 minus 10,000 deduction. Then what about the carrying forward of trading loss? How are we going to compute that? If a company incurs a loss, it can carry it forward indefinitely, provided it continues trading. Yes, it needs to exhaust that particular loss. It needs to finish it. And it can only lose that loss if it stops trading. But there was a loss in 2024 and a profit in 2025. Then the loss is taken against the profit, and in that particular year of 2025, the taxable income will be 50,000. Compute taxable income for companies. General companies, we know 27%. Small business, yes, we said it must be lesser or equal to 20 million. Shareholders must be individuals, cannot be a personal service provider. And that is the rates for 2025. Transfer pricing. What is transfer pricing? It is applies to transaction between connected persons, foreign subsidiaries. And transfer pricing, colleagues, it refers to the pricing of goods, services, or intellectual property transferred between related parties, or is a deal made between two independent and unrelated parties who are acting in their own best interest with equal bargaining power and no special relationship influencing the terms. In simple terms, it means the price, the terms, and conditions of the transactions are what they would be on the open market between strangers, not distracted by family ties, company affiliations, or other connections, like political connections. No, it must be an arm's length transaction. That's why I've explained it, that there must not be an influence in any way. If that's the case, if there's an influence, then SARS can adjust that particular transaction. Example, SA parent sells goods to its Mauritius subsidiary for 10 units below market value of 20 rand. Can you see? If SARS can see this and do its own investigation to say, but hang on, meaning that there is a relationship between the two. That's why it says as a parent, there is a connection. That's why the value is below the market value. Then SARS can adjust 10 rands per unit to its taxable income. And again, I've seen in the transfer pricing department at SARS, they do this investigation and they see and they know how to investigate whether there is a connection between the two. And if they found out there is a connection, meaning that there are some favors that have been done, then SARS has got that power to adjust the price. Foreign exchange gains and losses. Gains are taxable, losses are deductible. This is an example. Taxable of 50,000, loss of 50,000. Again, it is deductible as long as it is in the production of income. Let me see if there is an example for that. Okay. African Manzi Holdings Pty Ltd was founded on the realization that water shortage is going to be worse than load shedding in South Africa, because many countries on the continent will be adversely affected. The board was concerned about South Africa's economic and social factors and decided to set up their head office in Kenya for its central location and economic activity or economic stability. AMH advanced a USD 1 million is dollars loan to the whole-owned South African industry subsidiary Mzansi Water Supply on 1st February 2023 to set up their operation in South Africa. The loan is repayable in full on 30th September 2025. It is payable in June of each year at 9%, and at a maturity, the risk rate is market related. However, the yield to maturity rate is 11.5%. The group's year end is 30 June. The following USD against rent rates are published. Let's see. The spot rate, the average, and most of the transaction, guys, if I have to tell you, they happen on a spot rate at the current rate at particular moment or point in time. You are required to calculate and explain the tax implications of the transactions between the group companies. Let's see. It says previously, June 2025, deferred 533,300. Let's see. How did they get that figure? It is here. Why they did? Because the financial year end is 30th of June. And with this $1 million, then they've used 18, the currency, and minus. Let's see how 533. They say something on the 1st of February. They're saying it loans the South African company on this date. Then it means we need to use this 18, the spot rate, because that is the rate at that point in time. They cannot use after 1 February or before. They need to use the exact date. However, the financial year end of that company, let's see, the financial is June, isn't it? It's 30 June 2024. And the spot at that year end, it sits at 17,972. Then we need to take this amount minus 17,972 because it was being loaned at this rate. However, comes the 3rd of June, the rate drops. Then now, this amount of 533,000 is R1,000,000 multiplied by the difference between the two. Let's see. $18.505,075 minus 17.9742 brackets. Or 0.533 multiplied by 123. Can you see? Thanks to Tandega, she showed me yesterday. We don't have to put we need to put comma, not full stop. So yes, 533. We've got that amount because they say we need to prepare for the 2025. 2026 was nothing. Because can you see our transactions? The total, the current year. Again, look at what we are doing the current year. It's R1,000,000 current year. Let's see current year. Current year is our year because financial years on the 30th of June, meaning that this will be our current year on 30 June 2024. No, 2025. No, we are doing 25, not 2024. It's 2025. Sorry for that. Then it is 18,754 minus the previous financial year of 17,9,742. Multiply by R1,000,000, then we arrive at this amount of 780,600. And in 2026, again, it explained in 2026, 30 June 2026, how much was our spot rate in June 2003. This is 303,300. This is 7 is 18,754.8 minus 19,0578. Let's see, 19,0578. And this is in your textbook. This is the current year minus 18,754.8. Then we get to 303. Then when you add is 1,083,300. The total for that particular year is 550,600. Let's see at the end. They're talking about something here. This is the notes regarding to those calculations. It is in the textbook. Just have a look and try to understand. In fact, the most important is this financial year end, because it's 30 June 2023, 24, 2025. This is a commentary to our figures. Then they talk about interest deductions. Let's see, they spoke about interest deductions up there. They say the loan is repayable in full on the 30th of September and is payable in June of each year at 9%, and at maturity, this rate is market rate. However, the yield to maturity rate is 11.5%. The group's financial year end is 30 June. It's 910. Just check. Because there is an explanation for that. Because they say each financial year. So for 2023, is this amount? Can you see 11.5%, 11.5% with the spot rate at that particular point in time? Because we are using the dollars. 2023 is 910. Let's see, 2023 is 910. Yes, and 2024 again, 2 million, and so on, until we arrive 28,750. But I have never seen asking it in this way. They just give you, and even in the textbook, they just tell you that you need to be wary of the spot rate. They can give you this spot rate, the average rate, and they give you only the amount with the year, and they want to find out whether or which spot rate can be used for that particular year. Then it just has smaller calculations. Most of them, they're in a multiple choice format when they ask this kind of questions. So it is in your textbook, and they will tell you the format, how this questions is being asked. Guys, we are done for tonight, and we are done. And I would like to thank you guys, and our man of the moment, Serge. Thanks a lot. And guys, thanks
Yes.
for being patient until this time.
You are
Anything,
welcome.
guys, before we say goodbye to each other?
Remember,
And
guys, we are coming next week.
That is an announcement for Block
Yeah,
Week.
we're coming.
Yes, please
Oh,
come.
you are coming, guys. Next week, isn't it?
Yes.
All right. I'm sure we'll see each other next week, guys. God bless and enjoy the rest of the evening.
Thank you, sir.
Goodbye, guys.